The expression goes in cost cutting, cut the fat, don't hit the bone. Easier said than done, and really a delicate balance. Today's video, I want to talk about cost cutting within businesses. It's always something that we're involved with, whether pre-transaction, whether during transactions, whether post-transaction involvement, but it's always part of the conversation of the optimization, and whether it's actually going to take place while we're involved with the companies, or if it's just something that's kind of being thought about, discussed, or prospectively looked at by the acquirer. And so largely in the middle market and lower middle market businesses where you're talking employee counts of 10 to 100 people, sometimes a bit more, 10 to 200 people, there's not an enormous amount of fat on the bones of these types of companies. It's not thousands and thousands of employees, and therefore revenue growth is oftentimes the synergy that companies look for beyond or rather in lieu of oftentimes cost cutting. That being said, there's always efficiency to be brought to businesses, and it's always going to be something that's looked at. And therefore, we wanted to talk today about costs you want to cut, costs you don't want to cut. And so when you think of costs to cut, we want to say redundancies, things not core, and things restricting growth. So when we think of redundancies, if there's 10 people doing work that 2 people can do, they're oftentimes redundant situations. Now, you always want to leave room for growth in any particular scenario, but if the certainty is that, look, we're never going to need more than 4, no matter if we quadruple or 10 times the size of the business, therefore, we don't need that capacity at this point. So when you ever look at underutilized capacity is always a place to look. When you think of non-core, oftentimes being in the business jungle, any business is going to start seeing interesting opportunities. And they always say the biggest risk to a business is all of the other great opportunities that you don't pursue. And so as a business progresses, you will sometimes see these appendages start to grow up, these different paths or side quests, if you will, that are pursued. And oftentimes there'll be costs associated with that. And so if the acquisition or capital provision to the business is effectuating a redirection or perhaps a refocusing of the business, or just a further focusing on the core elements of the business, oftentimes where you can cut costs is, I think, trimming back or pruning, if you will, is probably a better way to look at it, some of these non-core activities. And then lastly, you want to say things that are restricting growth. And so that could be bad vendors, it could be bad personnel, so you can think of it from a toxicity perspective in that regard, or you could just say it's the keeping of certain activities in-house or the keeping of certain activities with vendors, but always looking at what is the growth. Like they say, life will break you at your weakest link. In a business, your weakest component within the business will be the limiting factor, and so if there is a limiting factor that's also costing money that could be more efficiently undertaken, that's an area to save costs. Now, let's take the corollary of that, and oftentimes these are double-edged swords, costs not to cut. And so we think of 3 general categories here. Things that impact the ability to sell, things that are incredibly difficult to replace, and lastly, things that impair long-term growth of the company. And so when you think of the ability to sell, oftentimes when people start looking at cost cutting, they say, well, let's eliminate certain salespeople, let's eliminate some of these business development activities, these marketing activities, advertising spend. But when you lower what's coming into the funnel, if you're not improving the efficiency of the machine, the same game of numbers is going to happen. You're just going to end up with less clients, and it creates this negative feedback loop that's problematic. And so we always try to say, if there's a way to make the machine more efficient, fine, but we're not going to, do not, and you should not look to cut costs that impair the amount of raw goods going into the sausage making machine, if you will. Those that are very difficult to replace is another area as well, particularly in this environment that we live in of difficulties or challenges from an HR perspective. There are going to be certain times where there are underutilized personnel within a company. Now, there's always this initial instinct of, well, let's just eliminate this role, let's give the responsibility to somebody else. But if there are unique skills, something proprietary about a particular person, a particular vendor, a particular software, a particular thing that would cost a lot of money to turn back on should the need be, and there's a probability greater than small that there will be the need to do that, you're better off incurring the cost. And so this is where the balancing act comes in, where it could feel like this person's underutilized, but you have to balance that with the challenge of replacing, whether it's, again, the person, vendor, service, etc. And lastly, I'd say things that restrict long-term growth. And so if you're a distribution company and you have a facility that's 50,000 square feet and you say, hey, I can get a real good deal on something that's 10,000 square feet and we could probably jam all of our stuff in there. However, we have no room for growth thereafter. that's a problem because you can end up in the same situation assuming things go well. So always take in the impression, right? We always say prepare for the worst, hope for the best, work towards the best. And so you always have to have that long-term growth. And so let me sum this thought up, right? And so again, cost to cut, cost not to cut. Always think of what impacts growth, what impacts the ability to sell, and what allows the business or helps the business stay laser focused on its core businesses. And lastly, what's going to be difficult to replace and what is the pain or cost of switching in certain situations. And so to just take it down to one analogy, as you're going with the business, you're running and you're running and you're running, and there's momentum that builds. And you build this business and you add things to it and you can keep running and running. And as you're heavier, you actually create more of an inertia, if you will. Think about glacier moving or a world moving with no gravity. That as this thing gets heavier, the inertia starts to build. And so that's the idea of business, that as you speed up, you keep growing and building. The challenge to that is, however, that if you're not running at a quick enough pace, if you haven't built up enough strength to do it and you add on too much weight all at once, it'll actually slow you down and it'll do the opposite effect, it'll really damper and impair. So it's always that optimal balancing of what costs are important and necessary, but more specifically, at which time and what season of the company, at what stage of its life cycle. And so that's the idea for today. Cost cutting within a business. Staying efficient without cutting off your nose to spite your face. Staying efficient without being penny smart and pound foolish. It's a difficult balance with business. We work with clients all the time, both in their operations of their companies as well as in the presentation of the business and the opportunities for future growth. But it's always something that we're always thinking about within every business. So that's the thought for today. Hope the week continues to go well for everyone. Keep pushing forward. God bless. We'll see everyone next time.